that if you look at the instances, the 38 instances when the VIX has surged more than 30% in one day, and then the median forward returns, you can see that 1 month later the median gains roughly 3%. That implies a 200-point gain for the S&P by mid-November. Okay, back to all-time highs. So we would be buying the dip. And in general, we think October and the rest of the year has seasonal tailwinds. Basically, between October and year-end, we should expect the S&P to gain around 4%. That implies 7,000. But as we've talked about before, because the Fed's been on pause all year and then they're cutting in September, that's just like 1998 and 2024. And the S&P did even better into year-end, up 14%. So I think 7,000 is just the base case.
It all started on Friday, October 10th, when President Trump posted a lengthy message accusing China of unfair trade practices and promising to retaliate with a massive new tariff increase. That message hit social media around 11 a.m., and markets instantly reacted. Within hours, the VIX exploded upward by more than 30%, the sharpest one-day jump since December 2024. Stocks sold off hard. The S&P 500 tumbled 2.7%, and traders scrambled to hedge against a sudden wave of uncertainty. But it didn't stop there.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Let me do some macro, because there's been some turmoil in markets lately. It all started with Friday, October 10th, when President Trump posted this very long post on Truth Social. And there he was talking about his concerns about actions taken by China and what he called export controls. And he was going to respond with a massive increase of tariffs. Now that happened at 11 a.m. on Friday, and after that, the VIX spiked more than 30%. In fact, that was the 39th highest ever surge in the VIX, so it's unusual, and the highest one-day jump since December 18th, 2024. Now, the markets fell 2.7%, so it was a bad day, but the volatility is what I've been focused on. And then at 4:50 p.m. Friday, President Trump took actions and imposed a 100% tariff on China. Now that caused a huge downturn in futures quickly during that short window. And crypto markets, which trade over the weekend, underwent a massive sell-off. In fact, it triggered what is expected to be one of the largest ever one-day liquidations, the largest really since 2018. In 2021, and in 2021 that had to do with FTX. To give you an idea, someone posted this on Twitter that outside of Bitcoin and Ethereum, which held up well, look at things like SUI or Cardano, which went from 80 cents to 30 cents. SUI went from $3.40 to 56 cents. So clearly a huge liquidation. But then by Sunday evening, President Trump said, don't worry about China, all will be fine. So in some ways, I guess that liquidation and turmoil over the weekend looks like it's largely going to reverse as we move through October. So that gets us to this point, which is that when VIX spikes happen, they usually happen at the lows. Now take a look here at the upper half of this chart is the S&P over the past year, and the bottom half is the VIX one-day percent changes. And as we highlight here, when you see these spikes in the VIX, one-day spikes, they usually happen at the low. So I think that's the case again. And in fact, the numbers prove this out, that if you look at the instances, the 38 instances when the VIX has surged more than 30% in one day, and then the median forward returns, you can see that 1 month later, the median gains roughly 3%. That implies a 200-point gain for the S&P by mid-November. Okay, back to all-time highs. So we would be buying the dip. And in general, we think October and the rest of the year has seasonal tailwinds. Basically, between October and year end, we should expect the S&P to gain around 4%. That implies 7,000. But as we've talked about before, because the Fed's been on pause all year and then they're cutting in September, that's just like 1998 and 2024. And the S&P did even better into year end, up 14%. So I think 7,000 is just the base case. And as for Granny stock, individual stock performance, the top 5 performers over the past week were AMD, Lam Research, Strategy.com, KLA-10 Core, and Robinhood Markets. A lot of this is just AI again. And what helped AMD was the OpenAI strategic partnership where OpenAI was going to take up to a 10% stake. That caused AMD to surge 20% and reach an all-time high. We're happy about that. Now, for those who think we're in an AI bubble, just keep in mind a chart I've produced in the past. The most important company to watch is NVIDIA, and it's trading at 27 times forward earnings. Okay, it's got a lower multiple than Costco, which is at 48 times, and at Walmart, which is 34 times. Okay, and equally important that if you go back to 1998, September 98, which is when the Fed was on and then cut in September, Cisco was the same stock then that NVIDIA is today, and it was trading at 56 times forward earnings. Look at its PE. In a year and a half, it went to 210 times earnings, a 4x increase in its PE multiple. Okay, that's what I would say is valuations where you can be concerned about valuations. Now, the bottom 5 stocks over the past week were American Express, Bank of New York, Netflix, Meta, and Live Nation. And as far as themes go, the best performing theme was global labor suppliers, led by AMD, followed by Style Tilt.
Can you tell me about last week and exactly what happened on that day? It almost looked like margin selling. What was that from?
Leverage is a hell of a drug, Joe. That's what I can tell you. What we saw is cascading liquidation 2.0. We saw this in 2022. In 2022, it was borrowers that were off-chain. This time, DeFi functioned exactly the way it was supposed to. There were some liquidations happening, triggered more liquidations, and we saw a $19 billion liquidation cascade. Again, leverage is a hell of a drug.
Matt, meanwhile, gold has, at least in recent sessions or recent months, has proven itself as non-correlated, rush to safety, all the things that Bitcoin bulls aspire to for the crypto trade one of these days. It's not here yet.
Yeah, I think it's here depending on your time frame, Joe. Yes, Bitcoin has been more volatile than gold. Gold is ahead of it right now, but I think gold's going to drag Bitcoin up. If you pan out over the last year, the debasement trade has been Bitcoin and gold. They've taken turns leading. Gold's ahead right now, but I think we're going to see a strong end of the year. So I wouldn't count Bitcoin out.
You can talk, Meltem, about, I'm not in a position to understand Solana and some of the other, when I get done with Ethereum and Bitcoin, then we're in Dogecoin type territory for me. They all move in tandem though, right?
Well, they used to, not so much anymore. I think what we're seeing is we used to view the crypto market as sort of one market. Bitcoin dominance, right, is still over 50%. So historically, things have really moved in tandem. When Bitcoin runs, alts will catch up and we'll see sort of the whole crypto complex run. I think this is the first time, this is year 11 in crypto for me, that there's no longer one crypto cycle. There's Bitcoin, there's altcoins, Ethereum, Solana, the high caps, and then there's everything else. So I don't think we have the same correlation we saw before. So it's no longer market beta of one. There's different subsectors in crypto.
Matt, we got our ETFs, we got our institutional, starting to see increasing ownership move in that direction. I don't know, is there another halving? What's on the horizon? Maybe some government, maybe finally getting some domestic regulation or clarity on what it's going to look like. Is that what's next for Bitcoin?
So for a short-term catalyst, for sure, progress on the Clarity Act in Congress, if we see that, if the government reopens, would be positive for crypto. But the real bull story for crypto is just the slow-moving freight train of institutional investment. I've probably done a half dozen meetings with institutional investors and financial advisors over the last 2 days. None of them talked about what happened over the weekend. None of them talked about the liquidations Melton talked about. They talked about this need to get exposure to crypto. They're currently on 0. They're going to 5%. That's the big story. It's a slow-moving bull market, but it's a very strong long-term bull market from my view.
While traders obsessed over weekend liquidations, institutional investors barely blinked. Lee met with several financial advisors and fund managers in recent days, and none of them even mentioned the sell-off. Instead, they talked about allocations. Most of them currently hold 0 exposure to digital assets, but plan to move toward 5% allocations over time. That slow, methodical adoption, what Lee calls the institutional freight train, is the real driver of the long-term bull market. Every month, more capital moves into ETFs, into tokenized funds, and into regulated on-ramps. Even BlackRock, once cautious on crypto, now embraces it fully.
Well, it is gratifying. I mean, what really identified us in the third quarter, the breadth of where we grew. It wasn't just one business area. It was from cash to our systematic equity, our AI-based equity team that grew $30 billion over the course of the year, $10 billion in the quarter. Crypto, our digital asset platform, our private markets platform, our investment technology grew as fast as they have in many, many quarters now. And then, just across the board, ETFs, record quarter. So it was not just one product area. It was not just one region. It was a completeness. And I think it comes down to the whole portfolio, the entirety of a conversation. When we bought BGI in 2009, no one thought you could marry passive and active. Well, not only we did that, we've transformed how a portfolio is being engaged. And now with passive, active, publics, privates, and then we overlay investment technology, and now digital, we're the firm that more and more people are going to worldwide.
What do you mean by digital?
I do believe we're just at the beginning of the tokenization of all assets, from real estate to equities to bonds across the board.
It's very loud here.
It is very loud.
But it's good. Capital's at work, Larry. You like that.
I love capital at work. Yeah. But there's $4.1 trillion of money in globally in digital wallets. A lot of that money is outside the United States. If we could tokenize a ETF, digitize that ETF, we could have investors who are just beginning to, invest in markets through, let's say, crypto. They're investing in it, but now we could get them into the more traditional long-term retirement products. So we look at that as the next wave of opportunity for BlackRock over the next tens of years, as we start moving away from traditional financial assets by repotting them in a digital manner, and then having people stay in that digital ecosystem. Mm-hmm. They can have their cash, and we have the largest cash money market fund that's tokenized called BITL. Our Bitcoin IBIT is now over $100 billion.
$100 billion, I know, from nothing not that long ago.
And 2 years ago, zero.
Yeah,
so
I know. Well, you weren't always a huge proponent of crypto, as we know. You love it now.
But I grow and learn.
I heard you say that on 60 Minutes.
I did say that.
Jim?
Yeah, Larry, I wrote How to Make Money in Any Market. A lot because of our talks. Yes, a lot because of what you did. And I dedicate a lot of it to you because I say that people don't know how to invest. People feel that their parents are going to be richer than they ever were. Do you feel that your offerings, if people were to embrace them and work at a company that had this, we could kind of change this world where younger people will spend more money on polymarket betting about whether on some political event, when if they go with what you have, they might be able to, through savings, be better, be wealthier than their parents.
So a great statistic, if you put money to work on January 1st, 2000, And a year later, you had the dot-com crisis. 6-7 years later, you had the financial crisis. You had the COVID crisis. You still would have made 8% compounded over that entire 25 years versus earning 1%. It is so compelling to be in the market, and this is the story. It's not about if our market's going up or down. Is there a bubble in crypto, or is there a bubble in technology? It's about being in the market throughout the cycle. Even if you put money in the United States in the year 1900, and then you had the Great Recession, you had the Depression, you had all these things, you would have earned over 9% over 125 years. So I'm not here to tell anybody if the markets are going to go up or down, but over a long horizon, and every individual who's thinking about it should be focusing on these opportunities. And I'm absolutely thrilled to see more and more young people investing in equities, not just Polycom. They're investing in equities. And if they can now translate that from just a trading and flipping account into a long-term investment strategy and be an owner of those over long horizons, over your lifetime, you're going to do really well. And another interesting point, I think I've said this before, but over a 30-year cycle, if you earned an extra 0.5%, over 30 years, 0.5%, your retirement pool of money is up 15% more. Just 0.5%. So the virtue of compounding over 30 years, there's nothing more important. And Jim, you write about this all the time. This is what it takes. It's about being in the market, being focused on this over a long horizon. And the young people who are worried, they're not going to have much to worry about. America still is the best place in the world to invest, and I would be continuing to invest here today.
First, panic doesn't always signal danger. Sometimes it signals opportunity. History shows that when volatility explodes, patient investors who stay in the market tend to outperform. As Tom Lee reminded us, even if you'd invested in 2000, right before the dot-com crash, or in 2007 before the financial crisis, staying invested would have still compounded your wealth by 8% per year over the long run. It's not about timing the market, it's about time in the market. And with the U.S. economy still the most dynamic and resilient in the world, the message is clear. Stay invested, stay diversified, and stay focused on the long game.